Women's Forum Senior Policy Analyst Patrice Lee-Onwuka, and KingView Asset Management CIO and Fox News contributor Scott Martin. Scott, what are you going to look for in that report? It seems dated now, but it's relevant now.
It is relevant and dated. But, you know, Neil, I'm looking for consistency because I think that's one thing the market is going to take well here is the market's digesting, as you and I have talked over the last couple weeks, this higher rate environment, this Fed that is being pragmatic and paying attention to the data and says, hey, we're going to do one more hike in December. Yes, we're planning for more in 2019, but we're going to be data dependent and market dependent. And as long as they stay on that message, I think the market itself should be comfortable.
Patrice, you know, the president's been very critical of the Federal Reserve, not so much because I think the public misread this for the rate increases, but the number of them and the almost inexorable nonstop pace of it. What did you make of that?
You know, the president is not shy when he is concerned about something, and he certainly is not shy here, even though it's a little bit different from past presidents. But, you know, I think he's considering the fact that interest rates have not really risen very fast. Unemployment is historically low. And now you're starting to see some, I think, some squishiness in some markets like the home the home market. I mean, September home building came in lower than expected. And then last week, I think we saw mortgage rates come in even 15% lower than this time last year. So, you know, as Americans are thinking about holding back on buying, that has a stimulating effect across, you know, different parts of the economy. And I think he's worried that this roaring economy can be slowed down by a speed bump of Federal Reserve interest rates.
Yeah, and we were just showing some of those that echo Patrice's point, Scott, in the even some of the auto suppliers, the housing issues. I believe they're already in a bear market. The Tolls, Lennars, Hovnanians, correct me if I'm wrong. So I'm wondering whether the market just can't get a grip on this either, and that you know, it's saying at least in some of these interest rate sensitive areas there's going to be hell to pay.
Yeah, I think the market's trying to figure out what Patrice noted there, and she used a very good technical term that I like to use, Neil, squishy, because that's really what housing. She's right, though. I mean, that really is what housing is today. Because I mean, look at some of the financials, some of the bank earnings that we've seen so far. We've got lending demand that's down. I mean, you've got this kind of like a little bit of unease. It feels like in the real estate market that is for many of us. I mean, you look at our homes. Gosh, that's our biggest asset on our balance sheet. So to her point, yes, if you start to feel like either you can't get out of your home or you're not going to be able to sell it for the price that you thought you could sell it for 6-12 months ago, yeah, that's going to put a crimp on your spending coming up into the holiday season.
You know, Patrice, one of the things that the president has done repeatedly, though, is to say, if anything goes south here, don't point the finger at me. You know, it's the Federal Reserve overdoing it. And the Federal Reserve sometimes has overshot things going up and down on rates. But he's trying to put it out there, quite understandably, for the midterms. I've created this economic juggernaut, this economy that's the envy of the world. I'm the one who's redoing trade deals to the benefit of Americans. That's what I'm responsible for. None of this other nonsense. What do you think?
Well, I think he's really putting it out there for 2020. I mean, we've only got 3 weeks left before the midterm. So even if the Fed hikes its rates, you know, you're not going to see an instant impact that will probably hit the midterms. But he's thinking about 2020, and he's thinking about, you know, the Fed being active over the next year plus, and that I think could have a real impact on how the market continues to do going into 2020.
Scott, when you look at the market, I don't know. I mean, we're trying to stabilize today. A lot of people read it was a week ago today that we started that 2-day slide where we lost almost 1,400 points in the Dow, I think. Or, you know, we came back on Friday. It's since stabilized. Is it your sense that normalcy, always a dangerous word, is returning, or are we just in for another half month of a rocky October?
Yeah, it's a question as to what is normal, because to your point, my friend, I mean, October normal is volatility, actually, if you look back in history, you know, so maybe this is okay, right? I'll tell you what happened, though, Neil, when you talked about that 1,400-point drop, you saw interest rates start ticking up. So investors were selling everything. Institutions were selling everything. They were selling bonds. They were selling stocks. And what we've seen since then, thankfully, is rates have calmed down. They've backed off those 3.25 highs on the 10-year note. That's something I'm watching going forward, because if they settle here, equities can find a bottom as well.
How much do the midterms play into this, Patrice? You touched on, you know, we're a few weeks away. The markets generally are factoring in a Democratic House. They can be wrong. They were factoring in a Hillary Clinton presidency, so what do they know? So I'm just wondering, is it your sense that an aberrant development that they're not seeing changes everything. And then maybe the stuff that Republicans thought wouldn't get done does get done, and stuff that Democrats thought could get undone doesn't get undone.
Yeah, I mean, I think the markets certainly have their eyes on the midterms, and I think generally people are expecting that Democrats will take the House and Republicans will keep the Senate. But it would be in that scenario. Of course, we understand that some of the deregulatory efforts, some of even the tax cuts could be at risk, or at least the extension, making the permanent of those tax cuts could be at risk. So we'll have to see. I think the markets, though, are not going to be so volatile in 3 weeks that they come crashing down and we lose thousands of points, but I could be wrong. I think folks are still, taking a long-term look at what has already been accomplished by the Trump administration, and a lot of those on the corporate side are permanent, which is a really good thing.
Scott, any worries you have on the Saudi front, real quickly?
Yeah, I do. It's destabilizing for a number of reasons, both economically and geopolitically, Neil. And I think it's something that, unfortunately, because of where we are in the process of figuring out really what the heck happened, we've got some time to work through before we figure out how this thing's going to pan out.
All right, look forward to seeing you tonight on Bulls and Bears, our hot new show at 5 p.m. Eastern Time in this network. Patrice, always great seeing you.
Good to